The next type of investment we're looking at is what's generally called covered call funds. Sometimes these have creative marketing departments that like to use other terms like enhanced income or equity income or some variation of that. And so why is this topic on the list? I have a screenshot here. This is an ETF managed by JP Morgan. The fund is JP Morgan Equity Premium Income ETF. The ticker symbol is JEPI if you want to follow along. And this was one of the hottest new funds in the last few years. This fund went from zero to about $30 billion in assets over the last 3 years since its launch. And so right offhand from this kind of the fund's homepage, what jumps out to you? Like the previous example, it's probably that dividend yield, just over 7% here. And I think this is a huge reason these funds get a lot of attention. And then you can see some marketing speak here down below that. Monthly income, stock market exposure, but less volatility. And so why would an investor, not want that, right? And so first we have to kind of understand what these funds are doing. And the fund management is pretty simple. They own stocks and then they sell call options on the stocks that they hold. So what exactly does selling a call option mean? Options are just another derivative out there that can get complicated pretty fast. But just for this webinar, a very high-level overview, a call option is just the right to purchase a stock at a certain price that's known as the strike price in some time period. And just to try to give you a simple example, here's the details from Apple's stock yesterday. When the market closed, it was about $188 a share. And below, I'm showing the details for the call options that exist for Apple shares. And what this option data shows you is just that I can purchase a call on Apple that gives me the right to purchase a share of Apple for $190. For 41 cents. In other words, if I buy this option for 41 cents, I can buy a share of Apple for $190 a share, no matter the price. If it goes up to $200, tomorrow, today, I can still buy it at $190. And so that's the intention of call options. What these funds are doing, though, is not buying call options, they're actually selling them. And so in this case, the fund owns Apple and it's selling that call option. So it's getting 41 cents from an investor. And if Apple reaches $190 or higher, that fund is going to sell Apple stock for $190. And so this fund sells the call and Apple never reaches $190, the fund keeps their shares of Apple. They still receive the dividends that you'd get like any normal stock investor would. And you also keep that 41 cents in this case from selling the option. And so that's what this fund from JP Morgan's effectively trying to do. They're trying to sell call options, get that extra income, that extra 41 cents every few weeks from their shares, and hopefully retain the Apple shares at the same time to give investors exposure to the market plus a little extra in income. And so hopefully that example just helped, made a little bit of sense. If not, don't worry, you do not have to understand the intricacies of options at all. Maybe at a high level, the pros and cons of these types of funds are that they're designed to produce a little extra income. So you're going to get a little more income. That's that 7% dividend yield compared to, maybe 1.75 or 2% for the S&P 500 now. The downside is that, and this is very significant over the long run, as we'll see in a minute, is that the risk you have is that you lose out on most of the gains in the stock market. And that's because when you sell an option, you essentially put a cap on the gains that you can get with that investment. Remember in our example, if Apple hit 190 a share or higher, this fund has to sell it at 190. So if Apple goes to 200, they don't receive that entire growth. All they do is sell it at 190. They get no more growth after that. And so just to show the impact of this, I thought just a few quick charts would be the best way. Here's a table of the annual returns of this fund over the last 3 years. So notice 2022, S&P 500 had a very poor year, right? Down about 18.1% according to this. And this fund was only down about 3.5%. So this was a great example of a time when these funds do better than the general market. They do better because in a falling market, the shares are not getting called away at all, right? Apple's never hitting 190, it's just going down every day. And the fund can then just continue to collect those option premiums. So 2022 happened. Many investors saw this. Tens of billions of dollars flowed into this fund. And then what happened next year? 2023, the stock market did what it does very often, and that's bounce after a very strong year. S&P 500 went up about 26%. And this fund returned just under 10% for investors. And so what happened here? The stock market rose and these shares got called away from the fund. They were not able to benefit from the rising stock market because they had sold these calls, collected some income, but now cannot participate in the growth. And just to see what this does over a relatively short period, here's a chart of the performance of that JP Morgan fund in orange here. And then the S&P 500, the underlying index for this fund, is in purple. And what you see, despite very strong outperformance in that 2022 time, even just over a few years, we're seeing that cap in growth starting to make an impact in the total return that investors have. And this fund from JP Morgan's relatively new. There's another fund out there that's smaller, but it has much longer history that gives you a really good sense of over decade-long periods how this strategy can really hurt long-term performance. So this is a different fund, ticker symbol QYLD, and so here, instead of the S&P 500, it's doing the same strategy on the NASDAQ 100. And the chart here just shows you the orange line is a basic low-cost ETF that just invests in the NASDAQ 100. Purple line is the ETF that's doing this covered call strategy on the NASDAQ 100. And there are years here where that purple line or that Global X QYLD has outperformed the market. But in the long run, the cap on that growth is just too big of a barrier. Investors in the long run just cannot keep up with the general market. And so just as kind of a summary and a few other quick points about these types of funds, this is going to be a broken record for the rest of this webinar. These strategies have higher fees, and so I'm listing some expense ratios here. At the very least, probably 1/3%, and you can get much higher, closer to 1%. These are also can create some high tax liability, again, if outside of a retirement account, and that's because these option sales are taxed at high income tax rates. They're not dividends, they're not capital gains. And more importantly, just is that these funds just don't give investors kind of that good optimal risk that you should be taking. Because if the market declines, you're still going to hold on to those stocks that are declining in value. You will get some kind of added benefit because you're getting a little extra income, but you're still holding Apple shares when they fall 40%. It does not eliminate downside risk of the market. And then if the market rises, your shares get called away. You're left just holding cash as the stock market's going higher. You don't receive the gain. And so again, just not a good balance of risk and return for investors, as we saw in those last few charts.